President Donald Trump is calling on the Federal Reserve to cut interest rates again, but markets are betting against it as the Iran war sends oil and inflation pressures higher. With crude oil prices surging again amid escalating conflict in West Asia, markets are bracing for rising inflation. Iran-led chokehold on the Strait of Hormuz, a shipping lane that handles roughly one-fifth of the world's oil, has pushed U.S. crude to about $95 a barrel. Higher energy costs are expected to flow through to gasoline, food and transport prices, pressuring consumers and businesses alike. President Trump took to social media platforms saying that the Federal Reserve must be dropping interest rates immediately, aiming to support growth and borrowing costs as well. However, investors are moving in the opposite direction. Before the Iran conflict began, markets were pricing in 2 quarter-point rate cuts by year-end. Now they are barely pricing in even one cut, if any at all. Well, part of the debate includes the Fed's leadership. Trump has selected former Fed Governor Kevin Warsh to succeed Jerome Powell as Federal Reserve Chairman this month, and Warsh is seen as more rate cut friendly. But even with the likely leadership change, inflationary pressures from the rising energy prices are counteracting expectations of looser policy. One major Wall Street bank, Goldman Sachs, now forecasts the U.S. personal consumption expenditures inflation rate rising to as high as 2.9% by year-end, above the Fed's 2% target that was set. They also delayed their predicted timing for a rate cut from June to September, while reflecting that the risk that inflation remains elevated for longer due to geopolitical disruptions. The ongoing tension has broader market effects. The bond markets have slashed rate cut expectations. The safe haven currencies like the US dollar have strengthened, and stock and risk assets remain volatile as traders reassess economic growth, inflation, and even central bank response.